Hello everyone. So today's let's start discussion on very important topic, guys, in a perspective of the development financial institution, which is a NaBFID. The topic is based on the credit appraisal note. We are going to discuss how to write the credit appraisal note and the purpose of the credit appraisal notes, and then five C's of the credit appraisal. That is the most important five C's, guys. You should know that thing while you are writing the credit appraisal note for the commercial bank or the non-NBFC or the foreign bank or the development financial institutions at national level or international level. In that case, you should know that five C's, that is a character, capacity, capital, collateral, conditions. Then we discuss on what are the difference between or the how the traditional banks and NaBFID. Then we discuss on the standard structure of the appraisal note, what it contain, what it does not contain. We discuss that thing, and then look on some financial ratios like debt service coverage ratio, PLCR, LLCR, and something. And then we going to move on the project appraisal NaBFID specific key terms, where we discuss on the revenue model or the project cost or the ECG framework. Then we look at how the risk assessment framework we going to add and what are the risks in the projects. We going to look on that project, and then we do the compliance checklist, which is the important part of the credit appraisal note while we are presenting that, and do's and don't while writing the credit appraisal notes. So guys, first understand what is a credit appraisal note. Basically, the credit appraisal notes is a notes which is prepared by the analyst and to submit to the decision making team or the decision making team in the NaBFID to on the basis of that credit appraisal note they are able to take a decision whether we are going to sanction the loans of that project or not, of that entity or not. So that's the overview are come from the credit appraisal note, and your credit appraisal note should look like while reading any one of that note he can understand what is the project, what is the objective of projects, and why you are able to give the loans for these projects. So that's the things that need to be contained in the credit appraisal note. So guys, before going to move in the details of the topic and explain you these things in detail, I would like to request you guys, if you are new to my channel and if you are serious about to look the opportunity in the development financial institutions, bank or the big four organization, or want to move in a career in the risk management domain, so or the quant analyst domain or the business analyst field or the quality analyst field, so please do like and subscribe my channel, because I am continuously creating and putting such videos on my YouTube channel. So that definitely help you to get a better opportunity in the market. So let's discuss on the purpose of the credit appraisal notes. So the core objective of the credit appraisal note is the investigate the commercial and financial and technical viability before the sanction. We are going to investigate, analyze, identify the commercials and the functional and the technical viability of the project. So we do the feasibility study where we are going to check is that project is a commercially, technically, financially are feasible or not feasible. Is that the project is generated revenue can satisfy the principal interest rate, and can equity holder get some profit from that project. So that's the core objective and the core goal and the core motive to create and the purpose of the credit appraisal notes. So let's discuss on the three key principles that you should be understand while writing the credit appraisal notes. So first one is a safety for the funds. We make sure that our fund is safe and we will receive the principal and the interest rate within a time frame or before the deadline which we are going to utilize on that project. Because guys, that fund is from the public sources where the individual can save their funds and invest that funds to get a better return. If we are not give the better return, or if you are not back their funds, so it will be, the economy will get stuck of India. So we make sure that the funds are in a safe hand, the funds are utilized in the purpose or the intent for which we are providing that fund to that project. So we need to monitor, we need to track the each fund's progress, then the liquidity and the profitability. So we are able to fulfill the liquidity requirement whenever the requirement, and we can do the profitable, we generate the appropriate amount of profit from that projects, we will do the profitability analysis for that project. So while we are doing the financing for something to get the profit, to get the invested amount return, so profitability is the most important and the key principle of the credit appraisal notes. How your profit would look like, what are the conditions you get the profit, so that's thing should be mentioned in the profit, and how much profit or the how much revenue you are going to generate from this project, so that thing need to be covered in the credit appraisal notes. So then discuss on the NaBFID focus on the credit appraisal notes. As an analyst, as an senior analyst, what your focus while writing the credit appraisal notes? So you should be a long-term infrastructure project financing with public importance. So you are going to finance to the infrastructure projects, and which is the long-term projects. The at least duration of that project is a 15 to 25 years, and there is a huge chance to get the construction risks, delay the cost overrun, or the major force major risks. So you need to understand that risks, and to focus on that risks and cover all these topics on in the credit appraisal notes. So then the outcome recommend the sanctions with risks based terms and the conditions. So you should be keep in mind all the conditions, all the covenants, and the risk-based approach before to sanction the model and to do the analysis on that thing on as a senior analyst or the analyst perspective. So guys, let's move on the next slide where we are going to discuss on the 5 C's of credit appraisal in a NaBFID framework. So that 5 C is the most important, guys. You should understand, or before going to loan in any terms, you should understand that 5 C's. First is a character, capacity, capital, collateral, condition. Character, capital, capacity, collateral, condition. These are the 5 C's you should understand. So let's discuss on each C in detail and understanding way. So first C is a character. So what is assess, what it contain? So it contain, or what it assess, the promoter integrity, reputation, and the credit history of the promoter. What are the character of that promoter? Is he able to repay the amount? What is the credit history of that promoter? We need to check from the character perspective, and the focus on the CBILs, RBI defaulter risks. We need to check RBI has a one list, which RBI defaulter list, that track all the defaulters in that list. The RBI will contain the features, name, date of birth, and all these things in defaulter list. So we need to track is the promoters or the all the UBOs or the promoter members are in that defaulter list, and the legislation checks and track record in the infra for help us to verify the the character. Then the capacity, ability to repay from the cash flows. So we need to check a capacity, because we need to identify how much the principal and the interest that the borrower will pay, and how much the capacity of that borrower will have to repay of the principal and interest rate on the EMI on the quarterly, monthly, annually, same annually basis. So we need to check there the capacity. Then in that case, NaBFID will focus on the infrastructure financing. For that is a debt service coverage ratio, or the project life coverage ratio, or the loan life coverage ratio. Then the project internal rate of return, escrow, waterfall, and the sensitivity analysis. So there they will check, and they make sure that they are the owner of that project on the cash flows of that project. So that's they check in the capacity. Then we move on. The third is a capital is the most important things, guys. So promoters own stake and the scheme in the game. So how much, if there is 100 rupees required for to develop that infrastructure project, so how much the debt equity ratio, how much the investment of equity in that project, so how much the skin in the game, how much the promoter in that the game. So we need to validate that the debt equity ratio is 70/30 or 80/20 in the portions of that. Then the upfront equity cost, how much the equity holder or the promoter will invest their amount in that project at upfront and the time of the project. We never rely on such commitments from the borrower or the promoter, like we are going to invest 2000 2,000 crores or 1,000 crores in something day and in the future. So we just rely on what is the current situation, what they are investing in the upfront, and also to check the cost overrun and the support from the promoters. So if the cost overrun, if the EPC contractor is not the fixed price, so how much the cost overrun, or the operation and maintenance contractor, or the raw material cost will increase. So what are the cost overrun support from the promoters? We need to check that covenants, and we need to check that conditions in the tri-party agreement or the concession agreement. Then collateral is a security available to banks. So collateral is the most important thing, and once the default will happen, so that's the security that available for the bank, and bank can sell that collateral amount and recover the money that a bank are invested. So the project assets, land, receivable, DSRA, debt service reserve account, and the guarantee or the major maintenance reserve account. These are all the focuses on NaBFID, and that are the collaterals for the banks. Then the condition. So, in a condition, the purpose, we are going to what assess the purpose, economic condition, and the sector outlook. So, what are the purpose? What are the economic conditions and the sector outlook for that project? Where the NaBFID will focus on the government policy, how much the government is involvement, and then the power purchase agreement or the public-private partnership or the TSA terms, regulatory risks, ECG compliance, it's how much that satisfy, and what are the conditions, all the clearances that require from the environmental, social, governance teams, or the other fields, or external or internal or external stakeholders who are need to give the approvals for that project. We need to check and verify as an analyst. So let's discuss on how the 5Cs differ for NaBFID versus the traditional bank. So what are the 5Cs of NaBFID are differ for the traditional bank? So let's discuss one by one character. So first is a character. So high weight on sponsor experience in execution the large infrastructure project. So there is experience, high experience, the credit history is a good, or the reputation of the promoter will be the great, and higher of the character will give the amount is higher. So that's we consider. Then the capacity, the focus on the project cash flows, not just a balance it, use LLCR, PLCR, and long term. Guys, understand in the infrastructure financing. So for that project cost is a 100,000, 2,000, 20,000 crore. So that the promoter will create a specific entity, specific legal entity, and they call this entity has a special purpose vehicle. It has own document, and that project cash inflow and outflow are not going to impact on the balance sheet of that the promoters, and it is under ring phase finance where we are not going to, if the default will happen, so we where we are not going to touch the personal assets or the balance sheet of the borrower. So we need to mandate to check the loan life coverage ratio, project life coverage ratio, or the debt service coverage ratio to maintain the debt service reserve account, or to maintain the major maintenance account. So that's the capacity we are going to check in the 5Cs of the NaBFID perspective. Then discuss on the capital. So capital, where the RBI and NaBFID guidelines may allow higher leverage for the infra. So we need to check what are the guidelines are assigned by RBI or the NaBFID, and what how much the investment done by the promoters, or how much the skin in the game of the promoters in that projects, and check the regulatory minimum equity. So if there is a regulator defined that minimum equity holder should be that much percentage, so check that minimum equity and make sure that the skin in the game or the promoter in the game with the minimum that much portion or the leverage in that the projects, and write that thing in your the credit appraisal notes. So then collateral and collateral. So in collaterals we check security available for the banks, or how much the project asset, land, receivable, debt service reserve account, or the guarantee that will provided by the borrower. So security obtain the cash, future cash flows, concessions rights, physical and collateral may be limited, how much the cash flows and how much the owning of that cash flow by the lender. So we need to make sure that and track each cash flow records. Then the condition. In the conditions, we are going to look at the externalities matters, public importance, for goal priority, sectors. In that condition, we check or the purpose or the economic conditions and the sector outlook, how the economic conditions, how that will be focused, and where we are going to check the government policies or the tri-party agreement or the power purchase agreement or the public private partnership agreement, terms and condition, regulatory risks, and the ECG compliance framework. We check all the clearances. So let's move on the next slide, guys, where we are going to discuss on the standard structure of appraisal notes. So what are the things that need to be included in the appraisal notes and what things we are going to add in the standard structure? So there are the borrower profiles, proposal details, financial analysis, project technical appraisal, risk mitigations, security and covenants, and the recommendation that analyst will give while doing while the ending of that the credit appraisal. So in the borrower profiles, we need to write the name of the borrower, then the constitutions in which the borrower will belong, and the promoters, who are the promoters, what are their the profiles, their history, their details of the directors, and that thing and the ultimate beneficiary owners, why, what is the purpose of that projects, and the groups, which groups involved to complete that projects, like the EPC contractor, operation and maintenance contractor, main borrower, or main the project sponsor. Then we add the who is the lender independent report, what are the content in the lender independent report, lender independence reports, all these things we write in that things. And the credit rating, who give the credit rating, what is the credit rating, what are the net credit rating for that the borrower. So that need to cover in the borrower profile. Then we move on the proposal details. So in the proposal details, we'll write the facility amount, how much amount is required, what, how in that amount, what are the debt process, what are the equity portion, what are the debt portions, and how that amount will the type of disbursements, it's milestone based or different type of base. Then the purpose of that projects, why that the project is created, what are the benefits we are going to getting from that the projects, what are the low toll cover, what are the types of that model, the build operate transfer, toll operate transfer, or the hybrid annuity models, or the build different kinds of monitor, or the structure of that projects. We then the tenure of that project, how much the tail period, how much the loan life coverage ratio for that project. So we discuss we write that thing, and the pricing and the repayments, how the repayment will happen in that projects. So then we move to the financial analysis, and it is the most important, guys, where we are going to discuss how the past 3 to 5 years working and the next 5 to 10 years projections, cash flows, cash ratios. We consider key ratios like debt service coverage ratio, we consider the project life coverage ratio or the loan life coverage ratio. We consider all these things and do analysis, do the stress testing, scenario analysis, sensitivity analysis on that all these ratio, and make sure that the debt service coverage ratio in all the condition above the one. So then the project and technical appraisal. So where we are going to discuss how much the cost, what is the means of project finance and implementations, what are the techniques, how we implement it, what are the technologies that going to utilize while completing that projects, what are the pros and cons of that each technologies, which is the best technologies, and that thing we write in the project technical and appraisal notes. Then we are going to discuss on the risks and its mitigation. So what are the risks are involved in that projects, how we mitigate that projects, what are the, so what are the things we are going to utilize while approaching that risks. So where we are going to consider the market risks, management risks, technical risks, financial risks. So we consider all these risks, construction risks, cost overrun risks, revenue risks. So we check the major force major risks. So we consider all these things, right covenants, who are the owner of each risk, how we can moving forward once that risk is occur. So all these things we write in the credit appraisal. Then the security and covenants. So primary, collateral, what are the securities, what are the covenants for that projects. Once if anything unexpected things will happen, how much the DSRA account will contain. It contain the 6 months principal or interest rate, or 3 months, or the yearly, the specific condition that need to be fulfilled by the borrower or the lender. Escrow mechanism, waterfall mechanism, how the funds will moving. First it will goes for the operation and maintenance, then the statutory or the taxes, then the lender for in the form of the principal and interest rate, then the major maintenance reserve account, then the operation and maintenance account, then the finally remaining amount will go in the retention for that projects, or finally distribute in the form of dividend to the equity holders. So that's the specific security and covenants will written in detail, and the recommendation, viability, deviation, final view that will suggested by the analyst or the senior analyst, that will be the part of the recommendation. Let's move on the next slide, guys, where we are going to discuss on the key financial analysis and the key parameters of the financial analysis, where we are going to check the past and the projections, for where we are going to check the revenues, what are the different projects in the infrastructure that the sponsor will going, what are the profit after tax trends, how much the profit. We do the stress testing, scenario analysis, sensitivity analysis. Then we check the all the ratios, like the current ratio. The current ratio is the current asset divided by the current liabilities. It should be always more than 1.35 or more than 10. We check that base case, stress case of the current ratio. Then the TD divided by the TWN. Then the debt service coverage ratio. In the debt service coverage ratio, we check the cash flow available for the debt service, which is nothing but the revenue or the cash flow that generated by that projects divided by all the expenses that include in that projects, like the operation and maintenance cost, or the statutory due taxes, or the all the things that need to be paid before going to interest rate and the principal to the lender. Then the TDNCR. Then we calculate the loan life coverage ratio. In the loan life coverage ratio, we check the net present value of the in all years of that projects, and then the total principal and interest that need to be paid to the lender from that project. So we calculate that thing. Then we calculate the project life coverage ratio. We add the tail period in the project life coverage ratio. Then the cash flow, operation cash flow versus the debt services. We check what are the cost cash flows for the operation cash flows, and how much the debt service we need to provide to the lender, that need to be checked in the cash flows. And then we check the working conditions, and the inventory delay, inventory days delay, receivable days, and the working capital gap. So we need to check the working capital, inventory days, and the receivable days, how much that days required, how much the working capital we need to require, how much the cash flow will happen. Then we do the sensitivity analysis, where we are considering the base worst case scenarios to calculate the debt service coverage ratio for the infra project, to calculate the LLCR, PLCR of the infrastructure project. So we do the sensitivity analysis, stress testing, gap analysis, or the scenario analysis in the financial analysis, and accordingly that all these things we put in the credit appraisal notes. We go the regulatory things, how much they define the clauses on the sensitive analysis. So let's move on the next slide, guys, where we are going to discuss on the project appraisal in the perspective of NaBFID-specific. So what are the project appraisal? So we are going to discuss on the critical for infrastructure finance. So the project cost, itemize break and the contingencies. We check all the contingencies and itemize the break up. We focus on the fixed term contract or the fixed price contract, because that will the risks we are transferred to the EPC contractor, operation maintenance contractor, to give the loan to the fixed price contract. Then the means of finance. So in means of finance, we are going to check what is the debt to equity ratio, what are the promoter contribution, what are the skin in the game, what are the at the initial stage while we are sanctioned, what are the promoters in that project, what things they influence to success to that project. So that we check in the means of finance. We calculate the implementation schedule, what is the commercial operation date, what are the commencement of commercial operation date and the timelines, how is that feasible, we in the technical or feasibility, is that achievable date. We analyze that thing, delay in risks, how much if the risks is happen, how much the delay. Then we check on the revenue model, where we check a power purchase agreement, we check the TSA concession agreement, traffic study, we check what are the terms and conditions, covenants that write in the concession agreement or the tie priority agreement, and what are the things that beneficial for in the perspective of lender. And we write down thing what are the or the not assumption good, not good assumption in a perspective of lender, or we write that thing in the credit appraisal notes. And the clearances, we need to check before sanction the amount, we need to check more than the 95% land acquisition will happen. We need to take the clearance from the environmental, we need to take clearance from the regulatory approvals, approve all the regulatory that involve in that projects. And then the ECG factors, environmental, social and governance, we need to verify and track and add all these factors like a sustainability, where we are going to make a profit to trees, and the social impact of that project is that project is beneficial for each other. So let's move on the next slide guys, where we are going to discuss on risk assessment and its framework. So where we are going to discuss four risk types and the mitigation in the NaBFID deals of each risk. So construction risks, market and demand risks, financial risks, and the regulatory risks. So the construction risks, I already told you guys, we are more focused on the EPC fixed price EPC contract, and also the LD clauses. What are the clauses are right in the terms in the concession agreement or the tri-party agreement or the power purchase agreement or the partnership agreement. So we need to check that thing, the LD clauses, cost overrun support, how much the support and how much the equity in the in the game in the cost overrun support if the cost is increasing, and the cost overrun or the major force effect. So market and demand, take or pay contract, if the complete the work and the payment will happen. So take pay contract, government guidelines, what are the guidelines of government for this project. So we need to check and verify that all these things. Then the financial risk, so we consider the this. So in such conditions, in the trades condition, the cash flow available for debt service, that will not the bank, the lender, the sponsor will not fulfill. So we need to maintain some funds in the DSRA account. We write down some clause and with the DSRA account, how much the funds, how much the duration that will be spent in the form of FDs or just put in the account. So we need to maintain that thing. And the escrow of receivables, so what, how much the receivable mechanism will happen, so what, how much the receivable will happen. Then the waterfall mechanism, we where we are going to discuss on the how the lender are the main monitoring the cash flows of that projects, and the initially operation and maintenance, statutories, taxes, and then the funds will go in the lender account, then the major maintenance account, then the operation and maintenance account, and then finally distributed to the equity holder. So that's the financial risk. And then the regulatory risk, so clause in changes in the clauses that may impact it on the projects, pass through in traffics. The clauses in the changes may be positive, negative, that need to be monitored and that need to be written in the credit appraisal notes. So let's move on the next slide guys, where we are going to compliance checklist. It is on the most important things guys, you need to before sanction or before writing the notes, you need to write the compliance checklist in that thing, where we are going to check the RBI norms, the for the particular project. It is the road project, it is the airport project, it is the solar energy project, or it is the water management project. So we need to check the exposure limits which is defined by the RBI, how much the date process in that projects. We are allowing the date and the prudential guidelines for that project. Then we check the NFB facilities only for existing customers or revocable and the unconditional. What are the NFB facilities that will provided? Then the KYC and AML. So promoter background and verification, all the details, the documents that collected from the promoters on the basis of the general partner, limited partner, ultimate beneficiary owner, directors of that project, or the design signatories on this document, or we collected these documents from the uh, that projects and verify that things in the compliance perspective. Then site visits. So lender independent engineer visit is the most important to check the to track the report of lender independent engineer, which report mandatory pre-sanction inspection report to track the progress of the infrastructure site, understand the goals, and understand is that achievable for that project is completing on before the commercial operation dates. So that's will visit the slides and actively visit the site, look at the construction progress. Then the legal, so title search, mortgages, perfect voting, and the guarantee will happen. So let's move on the next slide, guys, where we are going to discuss on do's and don'ts while writing the credit appraisal notes. Guys, this is a very important slide, and that will, while we are writing, so just keep in mind what I need to do and what I don't need to do. So then the map each risk to one of the five C's explicitly. So understand that five C's in detail and match each risk. So first C is a character, second C is a capacity, third C is a capital, fourth C is a collateral, and the fifth C is a condition. So map each risk with that C's and supports the capability with multi-year debt service coverage ratio chart to check that in how the debt service coverage ratio, how to support that thing, and justify if capital is below norms due to the project strategy and value. If there is a capital is a below the norms due and project strategic value, so you should justify, you should write clear the documentation that reader can understand how the capital will the below that thing, and the links the condition to sectoral policy and gati safety NIP, national infrastructure projects, so that you need to be check and verify. Then don't treat all five C's equally. Capacity condition dominated the infra finance, and don't ignore offtake the conditions, and don't skip the independent validation character for the new project. So these things is most important, guys, and do all these things in detail. Before wind up, I would like to request you guys, so prepare hard, do your efforts. I would like to best of luck for you guys, and thank you so much for attending this interesting seminar. I would like to again request you guys, if you are new to my channel and if serious about your career, and if you want to grow in your life, so please do like and subscribe my channel, so that motivate me to create and more such interesting videos for you guys. Thank you so much, guys.